The U.S. housing market didn't crash. There were no dramatic headlines, no sudden collapse, no moment where everything clearly broke. And yet, for millions of Americans, the housing market has effectively disappeared. Homes still exist, jobs still exist. People are working, saving, doing what they were told to do. But access, real access, has quietly vanished. For the first time in generations, you can do everything right and still find yourself permanently locked out, not temporarily priced out, not waiting for a better moment, just excluded. This creates a very specific kind of frustration, because when something fails loudly, people mobilize. When it fails quietly, people blame themselves. They're told the problem is timing, or interest rates, or personal finances, or patience. But deep down, many buyers feel something else, a suspicion that the game itself has changed, that the rules were adjusted without their consent and without their understanding. This video is about that feeling, not about a sudden crisis, but about a slow reconfiguration, not about individual mistakes, but about structural shifts. Not about why homes are expensive, but about why access was systematically narrowed. Because what happened to the U.S. housing market wasn't accidental. It didn't require a conspiracy. It only required incentives. And once you see how those incentives reshaped the market, the frustration so many Americans feel starts to make sense. Now let's look at where this really began.
Here's the paradox that defines today's housing market. The U.S. didn't experience a housing collapse like 2008, and yet for millions of buyers, the market no longer functions. The houses are still there. The economy is still producing jobs. People are earning incomes that would have supported homeownership in previous generations, but access has quietly disappeared. For a growing share of Americans, buying a home no longer feels delayed, it feels structurally blocked. You can save, improve your credit, follow the rules, and still lose out again and again. And that creates a very specific kind of frustration, the sense that effort no longer translates into opportunity. This is the structural pain driving the entire story. People are working more, often earning more than their parents did at the same age, yet finding themselves pushed out of the housing market anyway. When that happens at scale, it stops feeling like bad luck and starts feeling like manipulation, even if no one can quite explain how. The most common explanation offered is simple and reassuring. Interest rates are high, supply is tight, it's just a cycle. But that framing misses something crucial. Cycles move both ways. This one hasn't. High rates may explain why monthly payments hurt, but they don't explain why prices remain elevated even as traditional demand weakens. They don't explain why access keeps shrinking even when fewer people can afford to buy. And they certainly don't explain why the burden falls so unevenly on first-time and individual buyers. That's where the investigative turn begins. The core problem isn't just price, it's market architecture. A set of rules, incentives, and new participants reshaped housing from a place to live into a financial asset to hold. And once that shift happened, the market stopped prioritizing access and started prioritizing extraction. For the people living inside this system, the consequences are immediate and deeply personal. Families remain trapped in rentals year after year. Young adults delay children, stability, and long-term planning. Geographic mobility freezes as moving becomes financially impossible. This isn't a sudden shock, it's a progressive lockout. And understanding that lockout requires looking beyond headlines toward the structural changes that quietly rewired who housing is actually for.
For most of American history, buying a home meant competing with other families, people with jobs, savings, timelines, and emotional limits. That's no longer the case.
Today, individual buyers are competing against institutional capital, entities that don't rely on wages, don't need mortgages in the traditional sense, and don't operate on human time. They operate on balance sheets, algorithms, and long-term yield models. This is the central systemic failure most people never hear about. Homes stopped competing only within the household economy. They entered the financial economy. This shift has a name, but it's rarely discussed outside academic circles: the financialization of housing. Homes are no longer valued primarily as places to live, but as portfolio assets. What matters isn't shelter, it's future rent extraction, appreciation curves, and inflation hedging. And here's the counterintuitive part that surprises almost everyone. These funds don't need to dominate the market to reshape it. Even when institutional buyers purchase a relatively small percentage of total homes, they reset the price logic for everyone else. Cash offers above asking price become the new reference point. Appraisals follow, comparable sales rise, and suddenly the entire market adjusts upward, even for homes never touched by institutional money. For a first-time buyer, the experience feels surreal. You make an offer. You lose to an all-cash bid. You try again. You lose again, often to a buyer who never stepped foot in the house. Because many of these offers aren't people. They're generated by models designed to maximize return, not community stability. Speed matters more than neighborhood health. Yield matters more than long-term ownership. The structural analogy is simple. It's like playing a game of musical chairs where some players are allowed to buy extra chairs before the music even starts. When the music stops, the outcome was already decided. This is the moment where the housing market quietly tilted. Not loudly, not illegally, but decisively, away from individuals and toward capital that never has to live with the consequences. When home prices feel unbearable, the explanation offered almost everywhere sounds logical. Interest rates went up. And yes, higher rates make monthly payments heavier. They reduce affordability at the margins. But here's the problem with that narrative. It explains short-term pain, not long-term exclusion. Because if interest rates were the real villain, prices would fall when demand weakens. That's how markets usually behave. But that didn't happen. Instead, prices stayed elevated even as fewer people could qualify for mortgages. Buyers stepped back, yet the market refused to reset. And that contradiction points to something deeper than the cost of borrowing. The detail almost never mentioned is this: millions of existing homeowners are effectively locked in. They hold mortgages from years ago at historically low rates. Selling would mean giving up a 3% loan and replacing it with a 7% one. So they don't sell, they don't move, they don't trade up or down, they stay put. And that behavior isn't irrational, it's perfectly aligned with the incentives created by past policy decisions. But the system-wide effect is severe. When owners don't sell, inventory freezes. When inventory freezes, choice disappears. And when choice disappears, prices stop responding to demand. This is the structural revelation most buyers never hear. The system rewards retention, not circulation. Homes become parked assets rather than fluid places of exchange. Fewer transactions mean fewer real opportunities for new entrants, especially first-time buyers. So younger buyers face a market with fewer listings, worse conditions, and prices inflated by an artificial scarcity that isn't driven by population growth or construction costs alone. The correct mental model isn't money got more expensive, it's movement was engineered out of the system. High interest rates didn't create the exclusion, they exposed a market already designed to resist correction.
In cities where demand is highest, logic would suggest one obvious response: build more housing. More supply should relieve pressure. Prices should stabilize. Access should improve. But that's not what happens. Instead, many of the most in-demand American cities continue to restrict construction, especially dense housing, even as affordability collapses in plain sight. This isn't oversight, it's a structural contradiction built into local policy. The concept most buyers never hear about is zoning. On the surface, zoning laws are framed as protections, preserving neighborhood character, managing traffic, maintaining quality of life. But functionally, they operate as barriers to entry. By limiting what can be built, where it can be built, and who is allowed to build it, zoning rules restrict supply in places where people actually want to live. And when supply is restricted in high-demand areas, scarcity becomes permanent. Here's the uncomfortable revelation. In many cases, that scarcity is a feature, not a flaw. Rising home values benefit existing owners. Higher prices expand tax bases. Political pressure comes overwhelmingly from those already inside the system, not from those locked out. The incentive structure rewards protection, not expansion. The human impact is immediate and visible. Teachers, nurses, service workers, and public employees are pushed farther and farther from city centers. Commutes grow longer. Transportation costs rise. Time with family shrinks. Entire regions become economically segregated by income, not by choice, but by policy. This isn't a new pattern. Historically, medieval guilds controlled who could produce goods by limiting entry. They protected members by restricting competition. Modern zoning operates on a similar logic, not limiting production of goods, but access to space. The result is a housing market where scarcity isn't accidental or temporary. It's planned, reinforced, and politically defended. And for buyers on the outside, it feels less like a market and more like a closed system. Something subtle has been happening beneath the economic data, not just in prices, but in psychology. For an entire generation, homeownership stopped being a plan and became a distant maybe, not because people don't want it and not because they failed to try, but because the system steadily trained them to lower expectations. This is the emerging psychological pattern of the housing market. When access disappears long enough, people stop aiming for it. Renting stops feeling temporary and starts feeling permanent. And that shift isn't accidental. The hidden incentive is simple. Large property owners extract more value from constant rental turnover than from long-term stability. Rent increases reset with each new tenant. Fees multiply. Flexibility benefits owners, not renters. Instability becomes a business model. Here's the counterintuitive revelation. The more people give up on buying, the stronger the rental market becomes. And the stronger the rental market becomes, the harder it is to buy. As demand for rentals rises, rents increase. Rising rents make saving harder. Harder saving pushes more people out of the buyer pool, and the cycle reinforces itself quietly, efficiently, and profitably. The social consequence runs deeper than housing alone. Permanent renting means delayed wealth accumulation. Delayed wealth accumulation means weaker financial security, and weaker security reshapes everything from family formation to retirement planning. People aren't just losing homes, they're losing the primary asset through which the American middle class historically built stability. The symbolic shift is striking. The dream of home ownership wasn't eliminated, it was converted into a monthly subscription. And once a society accepts that shift as normal, the loss stops feeling like theft and starts feeling like reality.
When you pull all the threads together, a clearer picture emerges. And it's uncomfortable. The U.S. housing market isn't just expensive, it's been reconfigured. Not overnight, not through a single law or a dramatic event, but gradually, through incentives that favor patience, scale, and capital over participation, mobility, and work. This is the final synthesis. Buyers aren't losing because they made poor individual choices. They're losing because the game itself was structurally tilted toward those who can hold assets indefinitely, toward those who benefit from scarcity, toward those insulated from the consequences of rising prices. In this system, effort matters less than position, timing matters less than access, and ownership concentrates not because people stopped trying, but because the rules quietly changed. If this model continues, the implications are straightforward and sobering. Property ownership will concentrate further, renting will normalize across entire lifetimes, and social mobility, once tied closely to home ownership, will weaken without ever formally collapsing. That's the most important point to understand. Systems don't need conspiracies to produce exclusion. They only need incentives that work for a few while remaining invisible to many. Housing is simply one of the first pillars where this logic became impossible to ignore. And that raises a final question that extends far beyond real estate, one that defines the next phase of American life. If housing now operates under this model of quiet extraction and restricted access, how many other foundations of the American middle class are being reorganized the same way, just out of sight? That question doesn't end this story, it opens the next one.